Joining us now to talk about MF Global and a whole lot of other issues and banks and where he's putting his money, David Sowerby. He is a portfolio manager at Loomis Sayles, overseeing about $15 billion in equities. He joins us from Troy, Michigan, his office there. David, thanks for joining us. I know you're not long
Absolutely.
MF Global.
Thanks for having me on.
Yep, thanks for joining us. So you're not long MF Global, but what about some of the other brokers and banks? Are you long any of those names?
Yes. On the diversified financial side, I think Ameriprise represents excellent value for the financial service industry. Trades at a valuation like many insurance stocks at 8 to 9 times earnings when so much of the business is in asset management. And we know asset managers such as Franklin Resources, BlackRock, Legg Mason, Invesco, you name it, trade closer to 12 to 14 times earnings. I think that Ameriprise has potential value here. They have a number of funds, over 50 of them, that are 4 or 5 star rated. Last week, respectable earnings out of the company, favorable return on equity. I think from a financial standpoint, where you still might want to be underweight the regional banks and some of the larger banks in the more of the specialty finance area, particularly on the asset management side or capital markets, Ameriprise represents value with its more than 10,000 financial consultants.
And David, I appreciate that you like Ameriprise Financial, but you just said a very key comment, that is you want to stay away from some of the other money center banks. Explain why that is.
Well, it's as much as the money center banks are more of the regional banks, and what, you can own the very high quality ones that have very pristine loan portfolios, but until you see a material pickup in commercial and industrial loans, which can be beneficial to net interest margin, and as a result of that, I think the examiners are still pretty tough on the banks with regard to loan reviews. In that type of backdrop, it's still a more difficult environment than not to make money in the regional banks who generate value from commercial and industrial loans. I'd rather make money in other pockets of the financial services industry rather than in the regional banks.
David, you mentioned Ameriprise. That was a spin-off from, of course, American Express. But spin-offs, as a general theme, are something that you think are attractive right now.
I do, and my colleagues do. Over the years, we've had great success, particularly in the small mid-cap area, in buying special situation stocks that spin out from larger companies. What it's usually done is to unlock shareholder value, create better margin potential. Very often the large cap investor inherits a small stub, doesn't have the desire to want to look at it, can create selling pressure, but then a better buying opportunity. A name that we've owned for a couple of years that I still think represents great value is Sally Beauty, which was the spin out of the hair care products company Alberto Culver. Sally Beauty operates over 1,000 smaller retail beauty supply stores that are typically in strip centers. They're not large. They can be operated by one individual. The free cash flow yield is over 8%. They're growing square footage between 3 and 4%. They have a thriving customer relationship management with coupons that drives the traffic flow into the stores. And it's been a great margin story. The stock's up more than 30% this year. The valuation may look a little more rich at more than 15 times earnings, but with a superior business model, I think Sally Beauty, as another one of those special situation stocks, represents value for what's been a tough spot to make money in the markets, and that's in the consumer discretionary area, particularly in retail.
All right, David, I'm going to ask you to hold it there because we have another guest joining us, bringing in a slightly different perspective. We got Joseph Cusick, Senior Vice President of OptionsXpress. He's joining us from the CME Group in Chicago. And Joseph, give us a sort of macro sense of inflows, outflows for the month of October and what that tells you.
Well, right now it's telling us that there's still quite a bit of money is still sitting on the sidelines. Last week, we saw what we call a flat squeeze down here on the floor, where that sideline money, it came into the market because it got squeezed in. We saw that run up on Thursday. We saw it on Friday. And so those underinvested managers, that retail segment that has been sitting on the sidelines, agreeing with the move to the upside, they were waiting for a dip. They didn't get it. And then they chased the market. And now getting the news that we had today, you're seeing a little bit of pullback, but it's coming from overbought nature, so it's contained at this juncture.
Joe, does that mean you think there's a real room for a run-up then in November? Do you think we could see a repeat of October?
I think we're going to keep our eye on Europe, and I think that's one of those situations that we had some transparency last week of at least something getting started over there. We're hearing some grumblings out of Greece this afternoon. We saw what happened when we were looking at the Italian debt issues. The bottom line is that I think if we can get a better plan in place, something that everyone can see is actually in motion, I think there's a good opportunity to start testing that 1,300 level on the S&Ps, yes.
All right, Joe, we're going to go back. Thanks so much. That was Joseph Cusick joining us from OptionsXpress live from the CME.
All right, I have a question for David Sowerby. David, you manage $15 billion. Tech stocks looking pretty cheap. You could buy a lot of tech shares.
Number of individuals.
Yes.
Say that. Ask that again.
Yeah, Intel, what, 10 times, Apple 12 times. You buying any of the tech names like that?
Yes, in technology. I always like to clear things with my traders in advance. I think Oracle represents potential value on the technology side, trading at similar type valuations with very good free cash flow yield. There's opportunities in many of those names from both a valuation standpoint, a yield perspective. I think tech has really been able to navigate much of the tough waters here. Tech represents value for many investors. Pockets of the consumer does. And even on the industrial side, which got hit pretty hard, names like Honeywell, I think, offer potential value at 14 times earnings.
All right, David Sowerby of Loomis Sayles. Thank you, sir, for joining us. $15 billion. Always interesting to hear where you're putting it.